Hi, I'm Charles Bubeck with Vision Wealth Partners, and today I'll be guiding you through benefits decisions when changing jobs. If you're making a job transition, it's likely you have a lot on your mind. As you focus on wrapping up with work from your previous employer and prepare for a new role, it may be easy to let important benefits-related decisions fall by the wayside. If that happens, you could miss a limited opportunity to sign up for new benefits or miss out on the potential for making wise changes to your plans. To stay on track financially during a career transition, be sure to review the status of your retirement accounts and other valuable employee benefits. Many employers offer qualified retirement plans, such as a 401k or a 403b account. When transitioning to a new job, you are entitled to keep the vested balance in your qualified retirement plan, including contributions and earnings. You're also entitled to keep any employer contributions that have vested according to your employer's schedule. What can you do with the money? The following options are available. You can leave the funds in your current employer's plan if your vested balance is greater than $5,000. If the balance is less than $5,000, the plan could require that you roll over or distribute your assets. You can roll over the funds to an individual IRA or, if allowed, your new employer's plan. Withdraw the funds and pay any taxes due along with any applicable penalties. It's wise to consider carefully any decision to withdraw and spend your retirement savings. There are potential penalties and fees. It's also important to consider the possibility of premature distribution penalties, as well as any fees and expenses a new plan may impose. If you've separated from service in the year you turn age 55 or any later age, any assets distributed from your old employer's plan are not subject to the standard 10% penalty. Once funds are rolled into an IRA or a new plan, however, the 10% penalty may apply to any subsequent distributions if you're under 59.5 at the time, unless you claim an exception. As I said, you can roll funds into an IRA. IRAs generally provide more investment choices than employer plans. IRA assets can be allocated to different IRA accounts. There is no limit on how many direct transfers you can make from one of your IRA accounts to another IRA account in a year. This means you can easily move money between IRA accounts if you're dissatisfied with an account's performance or administration. While 401k distribution options depend on the plan terms, IRAs offer a little more flexibility. Still, you should be aware that when you reach the age of 73, you must start taking required minimum distributions, or RMDs, from traditional IRA accounts. There are no RMDs from Roth IRAs during the account owner's lifetime. When you roll over funds from a 401k to a Roth IRA, taxes will need to be paid on the pre-tax contributions. Any future distributions from the Roth IRA may be tax-free if IRS requirements are met. Employer plans offer the following advantages. If you intend to work beyond age 73, participation in the employer's qualified plan means you can typically delay the first RMD until the year you retire if the plan allows. An exception applies if you own 5% or more of the business offering the plan. Employer 401k plans may receive greater creditor protection than IRAs. Typically, employer plan funds cannot be used to satisfy most creditors, while the federal protection for IRA funds is more limited. Prepare a list of any stock options you've received from your employer. Often, vested options expire within a specified time frame when you leave a job. A decision on whether to exercise your options depends on your financial situation and whether your options are in the money, which means the exercise price is lower than the market value. Non-qualified deferred compensation plans allow executives to defer a portion of their compensation and the associated taxes until the deferred income is paid. With these plans, leaving your employment may trigger the need to take distributions in either lump sum or installment payments. You should be aware that any distributions will affect your taxable income. Once you start your new job, take time to understand the new benefit options, including health insurance, disability insurance, and employer savings plans. It's important to review how the new employer retirement plan options fit into your overall savings plan, including any employer matches. Remember to fill out beneficiary designations for insurance policies and savings plans, and review those designations periodically. Finally, if you've experienced a salary change, now is a good time to determine whether you should adjust your tax withholding and investment elections. For more videos on a variety of wealth management topics, head to our YouTube channel or subscribe. I'm Charles Bubeck from Vision Wealth, your dedicated wealth management partners.